Hello, everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia. Today, I want to spend some real time on a topic that quietly sits behind almost every major market move we see, yet is often misunderstood or oversimplified. We are going to talk about interest rate regimes, and more specifically, I'm going to walk you through interest rate regimes explained in a way that actually makes sense for traders and investors. When people hear interest rates, they usually think about a single number. They think about whether rates went up or down at the last central bank meeting. But markets don't move on single numbers. They move on environments. They move on expectations. They move on the broader backdrop created by monetary policy over time. That's what an interest rate regime really is. Interest rates sit right at the heart of modern financial markets. They influence how much it costs to borrow money, how attractive saving becomes, where capital flows globally, and how investors value future earnings. Stocks, bonds, currencies, commodities, real estate, and even crypto are all affected by interest rates, whether directly or indirectly. Once you truly understand interest rate regimes explained, you start to see market behavior very differently. An interest rate regime isn't about one decision or one meeting. It's about the sustained policy stance taken by central banks over months or years. Central banks like the Federal Reserve, the European Central Bank, and the Bank of England use interest rates to manage inflation, employment, and financial stability. But what really moves markets is not just what they do, but what they signal, what they prioritize, and how consistent they are. Markets are forward-looking. They don't wait for rates to change before reacting. They move on expectations of where rates are going and why. That's why interest rate regimes explain focuses on the broader framework rather than individual rate adjustments. When you step back and look at interest rate regimes, you're really asking deeper questions. Are interest rates structurally low or high? Is monetary policy becoming tighter or more accommodative? Is inflation the dominant concern, or is economic growth at risk? Are central banks predictable, or are they reacting under pressure? The answers to those questions shape investor psychology, risk appetite, and long-term capital allocation. Interest rate regimes are also deeply connected to economic cycles. Central banks respond to inflation, employment, and growth, but their actions also shape what happens next. Over time, this creates identifiable environments that repeat throughout history. Understanding interest rate regimes explained helps you recognize whether markets are being driven by optimism, fear, liquidity, or restraint. Let's talk about how these different regimes play out in practice. In low interest rate environments, central banks are usually trying to stimulate the economy. Borrowing is cheap, and saving offers very little return. This encourages spending, investing, and risk-taking. Equity markets often perform well in these conditions because investors are searching for returns. Growth stocks and technology stocks tend to benefit because lower interest rates increase the value of future earnings. Real estate often sees strong demand because mortgage rates are low, making property more affordable. At the same time, bond yields are compressed, which pushes investors into riskier assets. From an interest rate regimes explained perspective, low-rate environments often lead to asset price inflation, even if underlying economic growth remains modest. High-interest rate environments look very different. These usually emerge when inflation becomes persistent or when economic activity overheats. Central banks raise rates to cool demand and restore price stability. Borrowing becomes more expensive, and speculative behavior tends to fade. Equity valuations often come under pressure, and volatility increases. Cash and short-term bonds start to look attractive again because they finally offer meaningful yield. Currencies in high-rate economies may strengthen as capital flows in. In these regimes, protecting capital often becomes more important than chasing growth. Understanding interest rate regimes explained helps investors avoid being overexposed to assets that depend heavily on cheap financing. Rising interest rate environments are often the most challenging for markets. Even if rates are still relatively low, the direction matters. Rising rates signal that monetary policy is tightening and that the era of easy money may be coming to an end. Bond prices typically fall as yields rise. Companies with high levels of debt can struggle as financing costs increase. Investors often rotate away from speculative growth stocks and toward more defensive or value-oriented sectors. Financial companies may benefit from wider interest margins. This transition phase is where interest rate regimes explained becomes especially valuable for traders because markets often reprice rapidly during these shifts. Falling interest rate environments usually signal economic slowing or financial stress. Central banks cut rates to support growth and restore confidence. In these periods, bonds often perform very well as yields decline. Equity markets frequently rebound, especially in sectors that are sensitive to interest rates. Risk assets may benefit from renewed liquidity, while domestic currencies can weaken. Recognizing a shift into a falling rate regime early can make a significant difference for portfolio performance. Interest rate regimes don't affect all asset classes in the same way. Equity markets respond through changes in valuation and earnings expectations. Lower rates make future earnings more valuable, while higher rates reduce valuation multiples. But different sectors and styles behave differently depending on the regime. This is why understanding interest rate regimes explained helps you move beyond seeing the stock market as one single trade. Bond markets are directly influenced by interest rates, but regime awareness still matters. Long-duration bonds perform very differently in rising rate environments compared to falling ones. Credit risk, yield curves, and inflation expectations all play a role. Investors who understand interest rate regimes are better positioned to manage duration risk and credit exposure. Currency markets are heavily driven by interest rate differentials. Higher interest rates tend to attract foreign capital, strengthening a currency, while lower rates can weaken it. This is why forex traders pay such close attention to central bank policy and divergence. Interest rate regimes explained is foundational knowledge for anyone trading currencies. Commodities and alternative assets also respond to interest rate environments. Commodities often move with inflation expectations and real interest rates. Gold, for example, tends to perform well when real interest rates are low or negative. Even crypto markets have shown sensitivity to liquidity conditions created by monetary policy. Professional traders don't wait for official announcements to act. They watch inflation data, labor markets, yield curves, credit spreads, and even subtle changes in central bank language. They try to anticipate regime shifts before they become obvious. This forward-looking approach is central to interest rate regimes, explained as a practical trading framework. All of this knowledge becomes far more powerful when you have the right tools. Interest rate regime changes can trigger fast and volatile market moves. Having access to reliable data and execution matters. If you're looking for a world-class, cutting-edge, user-friendly trading platform app that helps you navigate changing interest rate environments, you can explore Crystal Ball Markets at crystalballmarkets.com/platform. It's built to support traders across asset classes with clarity and confidence. Learning macroeconomics doesn't have to feel overwhelming. You don't need to be an economist to understand interest rate regimes explained. What matters is consistent exposure to clear explanations and real-world context. One great way to do that is through audio content you can absorb over time. If you're looking for beginner-friendly discussions on trading, investing, macro, and financial markets, you can listen to the Crystal Ball Markets podcast at iss.com/podcast/crystalballmarkets. It's designed to make complex topics accessible and practical. History gives us powerful examples of interest rate regimes in action. After the global financial crisis, central banks held rates near zero for years. That environment fueled one of the longest equity bull markets in history and reshaped investor behavior. More recently, inflation shocks forced central banks into aggressive tightening cycles, leading to sharp bond market losses and renewed market volatility. These periods highlight why interest rate regimes explained is not just theory. It's essential context. The key takeaway is this: don't focus only on where interest rates are today. Focus on where they are headed, why they are moving, and what kind of environment they are creating. Adjust your risk exposure as regimes change. Diversify across assets that respond differently to interest rates. And make sure you're using tools and education that support macro awareness. Interest rate regimes are one of the most powerful forces shaping financial markets. When you understand interest rate regimes explained, You stop reacting to headlines and start thinking strategically. Markets will always evolve, but with the right perspective, you can adapt instead of react. Thank you for listening to Financial Market Insights for Traders. I'm Sophia, and I'll see you in the next episode.